All right, bank earnings are underway. Let's welcome in Jenny Horne, co-host of Next Gen Investing, to break down one of the reports. Jenny, Kevin was just saying that JPMorgan was higher and now is lower, despite a beat on both the top and bottom line. I was taking a look at some of the headlines coming out of the earnings call, which is going on right now. JPMorgan CEO Jamie Dimon says odds of a recession are at 50%. Does say that he's not seeing any signs of distress in low-income customers, which I think is good news. Smaller businesses, under a bit more pressure compared to their larger peers. So just some of the headlines coming out of there right now. But break down these numbers for us and potentially, let us know what's going on. Why isn't the stock higher? Because we know it was lower year to date heading into this report. So the bar was pretty low.
Yeah, the bar was pretty low. And I will say that there was still a lot to like within the report, despite the fact that we've given up that initial strength, like you said. So net revenue rose by about 8% year over year to $45.3 billion. That drove its net income up 9% to around $14.6 billion. So we did also see they boosted their provision for credit losses by $973 million to $3.3 billion. For the first 3 months of this year, citing a worse macroeconomic outlook. And earnings per share came in around $5.07 versus the $4.62 expected. And I also did see and appreciate the fact that they acknowledged the range of businesses right now that they serve, being the nation's largest bank. And I also oftentimes think a great read on not only like the overall financial system, but also the health of each individual consumer. So when you see the results, I would say nothing makes you say that there's any degree of pause in their financials. But I think that so much of the risk is the headline risk, and you have Jamie Dimon at the helm of your company, a widely respected voice of Wall Street, saying that now there's a likely outcome that we could have a recession, saying the economy is facing considerable turbulence, including geopolitics, with the potential positives of tax reform and deregulation and potential negatives of tariffs and trade wars ongoing, as well as sticky inflation, high fiscal deficits, and still rather high asset prices and volatility. So I read the entirety of his shareholder letter. I would really highly recommend actually looking into that, because I always think it's so interesting. But then I'm just fascinated by this company. So I went back to his comments over the last, let's say, like 5 or 6 quarters. And so just for some context, because the first thing I saw when I woke up this morning was him saying, basically, we're going to be in a recession, and also that analysts have reduced their S&P estimates for earnings by 5%, and he thinks that'll come down some in the coming days. So just for some context, he said back in the fourth quarter of 2024, geopolitical conditions remain the most dangerous and complicated since World War II. He said in the third quarter of that year, geopolitical conditions are treacherous and getting worse. And he also said that in the third quarter of 2023, it was the most dangerous time for the world in decades. So I didn't realize this, but just to share, he's doomsday a bit. And so I'm not saying that that's not true and there's not real evidence to what he's saying. But if you're trading on the notion that JP Morgan is calling for a recession, he's done this similar, in doomsday rhetoric before.
Yeah, and I guess 50% chance of recession means that there's a 50% chance that it won't happen. He says, as always, we hope for the best, but prepare the firm for a wide range of scenarios. And it seems like from the headlines coming out, at least from the CFO that we're seeing, they're saying, consumers are basically fine. The CFO said we're seeing consumers pre-buying stuff that may get expensive due to tariffs. I've thought about doing that, but as if I need any more Amazon packages coming. And then the consumer spend has been rather consistent. So obviously we eventually will see if that's some of a pull forward or not. But yeah, no, it's interesting amidst this economic turbulence. What about Morgan Stanley? Earnings also out this morning. Looks like Morgan Stanley, obviously we have about 15, 17 minutes to go before the opening bell, but looks like Morgan Stanley's under some considerable pressure in the early going today as well. What did we learn from that report?
I know, and this is odd to me too, because okay, with JPMorgan, I could at least say, hey, when you have your CEO in the face of your company making some more downbeat commentary, sure, I can understand some pressure. But Morgan Stanley, there was actually a lot to like within some of these numbers. Earnings per share rose about 26% to $2.60. Revenue rose a whopping 17% to a record $17.74 billion. Equity trading was the standout of the quarter as revenues jumped 45% to $4.13 billion, with about $840 million more than estimates, so blowing past expectations. Also said that the equity results were so strong across their franchise, but particularly in Asia, and their operations are catering to hedge funds driven by the most strong client activity in a more now volatile trading environment. Elsewhere, they pretty broadly met expectations. Fixed income trading rose 5%, while investment banking rose 8%. Wealth management, which was really a standout of last quarter, rose about 6%, matching the estimates. So, like their peers, we've seen them whipsaw in recent days as a result of the overall turbulence and the increased concerns that the U.S. could be in trouble here. But their wealth management business was also aided by the fact that we saw high stock market values in the first quarter, which helps then inflate, of course, the fees in which they collect. So I think that there's still a lot to like, but maybe perhaps the thinking is a lot of what drove this quarter could dwindle or somewhat dissipate if we see conditions change. Because I think that that's the major question. We're in the theme we've heard from big banks, at least so far, is that, yes, things remain strong this quarter, but we're not really sure what happens next. And the market does not like that kind of uncertainty.
Yeah. And there's certainly a lot of uncertainty out there. Jenny Horne, thanks so much for breaking down those earnings for us.
Thanks, Carol.